In the high-stakes environment of Wall Street, success is often measured by the ability to project an image of absolute stability. The financial system relies on a basic promise of opportunity. Financial visionaries leverage this inherent trust, using it to build reputations that eventually become untouchable. Jeffrey Skilling was the primary architect of this brand of invincibility. At Enron, he constructed an energy empire that appeared to have solved the problem of market volatility. Simultaneously, Bernie Madoff built a parallel machine, an investment firm that delivered impossibly consistent returns, year after year, regardless of market conditions. This chart tracks the compounding growth of these firms. They generated over $100 billion in reported revenue and commanded total market obedience. Because these men were perceived as the creators of a new economic reality, the public and even many experts simply stopped looking for the fraud underneath. The unraveling begins with a walkthrough of the public data. Investigators move past the glossy annual reports to analyze the raw numbers. They find trace evidence, microscopic mathematical anomalies where the reported profits fail to align with the actual movement of cash. The methods were systemic. Line costs were underreported to make the business look leaner. Revenues were simply inflated to meet quarterly expectations. This bar chart shows the reality. While reported profits climbed, actual cash flow remained stagnant. These discrepancies compounded into billions of phantom wealth. Regulators reviewed these exact figures for years, yet failed to connect the anomalies to a systemic issue, allowing the machine to continue. These were deliberate mechanical structures designed to maintain the appearance of health while the underlying engine was already failing. To understand how the fraud survived, we have to look at the hidden blueprints used to bypass the rules. The primary mechanism at Enron was the special purpose entity. These were shell companies created for a single purpose, to act as a warehouse for the corporation's toxic debt. This flowchart tracks the movement of that debt. By siphoning liabilities into these obscured, disconnected SPE nodes, the architect creates a shadow ledger that keeps the main company looking highly profitable. This system only functioned because the chain of custody was broken. Major accounting firms like Arthur Andersen validated these fake ledgers despite the glaring discrepancies. These auditors stopped acting as gatekeepers. Instead, they actively assisted in destroying the forensic proof that would have exposed the mechanism. Madoff operated with a similar detachment, bypassing major derivatives firms to fabricate trading reports entirely from thin air, without any underlying market activity. The genius of the fraud was the use of the regulatory system itself. By securing official certifications, the architects forced the system to validate the illusion. It takes more than just technical skill to build a fraud of this scale. It requires a specific psychological profile. By hiding billions in debt through accounting loopholes, executives like Jeffrey Skilling and Andrew Fastow transformed human livelihoods into abstract data points. This technical abstraction facilitates a total detachment, where the architect views employee pensions and life savings as variables to be managed on a spreadsheet, rather than human stakes. This allows the mastermind to operate as an absolute outsider, disregarding the ethical standards expected of the financial community while maintaining an elite public status. As long as the payouts remain consistent, the market typically suspends its skepticism. The results are accepted, and the ethics of the process are ignored. But the machine eventually runs out of room. During the 2008 housing and telecommunications crashes, a vital gear in the financial system shattered, bringing the momentum to an abrupt halt. When market liquidity froze, the mechanism could no longer sustain itself. Investors demanded real money from a vault that had always been empty. As the crash hit, the financial trap snapped shut, resulting in the immediate collapse of the empires. At Enron, the complete loss of value of its stock forced the company into a spectacular bankruptcy. Madoff's Ponzi scheme finally disintegrated when the pressure of the crash caused his own sons to turn him in to federal authorities. The human toll was immediate. While the architects faced legal battles, thousands of innocent office managers and employees saw their careers destroyed and their pensions vanish. The machine required a continuous intake of new capital to survive. When that capital stopped, those who provided the fuel, the workforce and the pensioners, were the ones left to absorb the entire loss. The forensic history of these cases reveals a massive discrepancy in how the system actually functioned. Major derivatives firms had suspected Madoff was a sham for a full decade before his arrest. They realized the math didn't work and actively refused to trade with him. Yet these institutions stayed silent. Wall Street provided an environment where the fraud could be incubated and protected for years. The catastrophic failure of these empires forced society to rewrite its legal boundaries. New regulatory architectures were constructed directly from the ashes of these scandals, designed specifically to prevent the mechanism from ever being rebuilt in the same way. The final fate of the masterminds was absolute. Jeffrey Skilling was sentenced to over 24 years in prison. Bernie Madoff received 150. The architects are gone, but their blueprints remain as a warning. Unchecked ambition will always seek to bypass the moral boundaries of the world.